I'll just share my screen and.
Okay, I think we're recording.
Awesome. Go share my screen. Can everyone see this?
Yes.
Yeah, looks good.
All right, great. Hey, before I dive into this, I just want to make a couple of announcements just to make it clear. One, this document has not gone through full legal review yet. Hence, it will not be distributed after this call until we have a full legal review. So please realize that phrasing, wording, and specific provisos may need to be updated. However, this will be a very strong indication of like where the economics are, and we don't anticipate any major changes to the terms, just phrasing here. And two, please realize, you know, a lot of people have asked questions back and forth. Please realize a lot of effort was put into figuring out what discounts, seniorage, et cetera, would look like to be competent with the market. And some of the changes to what we've announced before, like the 18-month to 6-month change, are largely driven by external market forces. Some of this is chicken and egg, and you know, you have to go out with a proposal, test the market a bit, figure out what you're getting back, and then optimize accordingly. We think that feedback loop has been done a few times, and we're fairly confident with where we've ended up. But just want everyone to realize that that's the process that's been taken here, and we feel pretty comfortable that we're fairly well baked. Any questions on that, or should I just dive into the? Karen, I'm sorry, I couldn't hear that clearly.
Oh, I'm at the airport actually. What you're hearing is the background. I'm getting the flight to Berlin. I was just turning my mute on right now. I just came in. Sorry about that.
Oh, don't worry about it. Thought you had a question. All right, I'm gonna dive into the slides. I'll pause at the end of each one for questions. So, pricing and reward principle summary. We're just gonna state the principles here. One, economics are gonna flow to validators from 3 sources. One is an upfront discount, which will go both to purchasers during the private sale, validator sale, as well as existing ROC holders who signed the contract to commit for a 6-month bonding period post-mainnet. 2, there'll be ongoing seniorage and interest, and this will be at a 7% rate for the first 18 months post the mainnet release. And we'll talk about this later, but the idea is over time, we want the third flow of economics, which is transaction and storage fees, to be the major economic component. Any questions on this one? All right, I'll go to the next one. So up front, there will be a purchase discount. There's 2 elements here. Base discount of 0 to 6%, that's 0, 3, and 6% depending on tier. You can see the tiers on the left. The smallest tier is 1,500 to under $250,000, $250,000 to under $1 million is the second tier, and the third tier is $1 million plus. Then there's an added 18% discount up front. So, you know, we're 18 to 24%. If you remember, during both our private sales, 20% was sort of the highest level discount, so we're very close to that. So I want to draw the nuance here between existing ROC holders and people who participate in the validator sale. People who participate in the validator sale, the way this will work is we'll look at the 3-day trailing average on CoinMarketCap. We will assign a price that is a discount based on the chart on the left. So if you're $1 million plus, we'll discount that 3-day moving average by 24%, and then deliver as many ROCs as that buys relative to the committed amount. So anyone who watches this video, ideally, we'd love your committed amounts to be in US dollar equivalent, unless you know the number fits so neatly in one of these buckets that we know what discount to apply. Secondly, what happens to existing ROC holders? For existing ROC holders, you sign the 6-month lockup contract. That's 6 months from mainnet launch. And once that's signed, what's going to happen is an amount of ROC to make you whole, meaning say you're saying I'll stake 1 million rock. A 24% discount means you should get 310K more rock. If you were to discount price by 24%, so that 310K of rock will be stored in a separate wallet. So you'll be able to track it, you'll be able to see it. Upon bonding at mainnet, when you bond that 1 million rock and verify it, that 310K will go into that bonded wallet. And so we'll set up the processes to make that happen. And so that's really the difference between existing holders who want to stake. Because and the reason why we're doing both of these is we really want to incentivize staking and securing the network. I also do have to state that this is a one-time thing for existing rock holders. Going forward, we'd be unable to replicate the same thing. Since this is the first time we're staking the network, we're doing it for existing rock holders. But a backward-looking make-whole provision is unlikely to ever be instituted again. Just don't want to set that precedent. So I'm gonna pause there and see if there are any questions on this slide.
I have a question.
Yep.
Does that mean that someone can buy without locking it up?
No, they cannot buy without locking it up. There's a 6-month lockup period.
Right, okay, thanks.
Yep, there's a 6-month lockup period. There's a full legal document. I know on one of the channels I'd posted it. I think it was the informal channel, but it's going under full review. It's going to be a standard, very buttoned up legal document. In addition, post mainnet launch, the lockup will be enforced via bonding. So the bonding period is going to be 6 months, 6-month increments.
Yeah, it's confusing because you split it to base and lockup discounts. So people might think.
Sorry. Yeah, no, what I meant to say there is the 18% discount is for everyone. And then based on your size, you can unlock an additional 3 or 6%.
Cool, thanks.
Yep, sorry, yeah, now that I read it, that wasn't very clear. Anything else? Any other questions?
This is Jonathan. I have a potentially awkward question, which is, how do we know that the legal contracts that we are signing with parties ex-US actually have any teeth and jurisdictional leverage on our part?
Hey, Jonathan, I can answer that. So we don't necessarily have any we don't have any guarantees. And so we have thought about this. And so in places and situations where we don't think a contract would be honored or enforced, we are considering smart contract alternatives or just very simple wallets, similar to what would happen with what Mrinal just described for existing rock holders. So let's say someone came to us and said they really wanted to become a validator, but we had, for some reason, we didn't trust that they would actually hold on to these rock until mainnet. We might insist that we hold on to those rock for them in a separate account until such time that they're ready to stake.
Jonathan, another thing that is part of the validator process is the KYC process that we're going to be going through. And so that gives us an opportunity to do some due diligence on who is entering into this process. And we can get comfortable there with who these individuals or entities are. And I think that that's part of our best bet in enforcing is making sure that we have a good reassurances around our diligence process. And then additionally, there's what Kenny has mentioned as well.
Great. Okay, thank you.
And Jonathan, I think you bring up a really good point. I just want everyone to know what are the 4 things that need to be done for a sale to occur. So one is KYC, as Kevin mentioned, and all standard KYC. US investors will have to be accredited, and everything. We're partnering with CoinList as well, and there are rigorous standards for the KYC process. 2, you have to become a member of the co-op. So the person will be a member of the co-op, therefore they can be tracked and have a Discord ID, etc. 3, and this is via the legal 3, you sign up for a hardware provisioning plan, which means when you're signing the contract, you're basically saying that I will commit to buying hardware that meets certain standards. Now, we've not announced that yet, but we've told them at a high level, and people who do this will see it in the document, the kind of flavors that will take. But by signing the document, you are agreeing to that. And then finally, 4, you're agreeing to the lockup and all other legal provisos that are in the document. So there's 4 levels of checks, and all those processes have been set up. And again, the reason why some of you might have heard back from us with an initial email but haven't had a follow-up in a while was we were setting up all those processes in the background and just doing 1 or 2 test cases to run through the process and find any bugs. Because our idea is to have hundreds of validators on the system, and we just wanted to make sure we got this really, really tight before we open the floodgates. But everyone will be responded to, and everyone will have an opportunity to take part of the sale.
So I have a question. Why are we not just selling revs? So if the idea is to use it now on the testnet, we can just sell revs. No one can trade revs. It's not an ERC20. No exchange accept revs. It can only be staked in the testnet. And they will earn their interest, and it will convert it to the Genesis block.
Yeah, the technical complexities of doing that would just burden Pyrofex to an extent that we don't think that's an acceptable delay to the process.
Right, but that's either way. They need to convert revs for the testnet. I mean, the whole point of selling it now was
having different tranches of pre-converted and non-converted ROC and Rev could be a logistical nightmare, especially given the scale of demand we're seeing in the number of wallets that'll be out there. And 2, survivability of smart contracts across the conversion can't be guaranteed. I think those were really the primary reasons. Kenny, anything I missed there?
No, I don't think, other than that does make sense. But Dror, we're not really at the point in the process where we can make changes like that. I do hear the point, and I think it would have absolutely been something to consider. And I think we did consider something like that, but for the reasons Al said, we couldn't move forward with it, nor could we. At this point in the process, we're making small, minor changes. Any major changes would be really just not feasible.
Another point, Dror, is that with testnet, there's the possibility of bugs, and we wouldn't want it. That would be bad.
Again, so actually, it actually simplifies things, because end of the day, before mainnet, everyone will inspect the Genesis log to make sure rocks were converted. So in this, you're gonna inspect it now. You basically have the same address, a random Ethereum address, but you can see there's revs there, and it will be logged at the co-op and at Pyrofex. So if there's a bug or something, people can track it. Now, if we're giving out rocks and people will stake them as revs on the testnet, and there's bugs, basically the same thing will happen if we're giving them revs.
Yeah, but Dror, you're missing a huge point here. The fact that ROC is an ERC20 allows people to store it either in cold storage, in a MetaMask, in a hardware wallet, etc. So if we're issuing our own token that's a non-ERC20, or if you're just saying issue another ERC20 token called Rev, you're basically just duplicating that problem.
No, so we don't need to issue any
ERC20,
right?
Yeah, but I'm just saying custody is an issue, right? Like all these guys who are doing $1 million plus need to be.
It's not an issue because Rev doesn't exist yet, right? So it's just kind of like, could be just on GitHub, let's say, there's an address and there's the amount of Rev. No one can hack it. No one can do anything because it doesn't exist. So
Yeah, because we want to incentivize people to validate during the test phase as well, not just post-test. Yeah.
Yeah, so again, so those revs are only on the test net. No one can like transfer them or do anything. If there's a bug or anything, Firefox can like just roll it out again. It's just a public ledger that says this guy has.
But George,
Okay, hold on. Hey, this meeting is for discussion and
Yeah,
questions.
okay.
about the
I'm just saying.
presentation. So,
Okay, I'm okay.
Yeah. So let's go ahead and move on.
Yeah,
But
okay.
appreciate the point, and let's take it offline.
Yeah, we'll take it offline, Drawer. But look, long story short, we explored options like that. They're not technically feasible in acceptable timelines. That's all.
Okay.
Any other questions on this slide, or would you like to move to the next one?
Mrinal, I don't know if this question is appropriate for this slide or later, but at some point, I hope that there can be a small discussion of pooling, because a lot of people would want to stake but not be directly involved, and I don't even know if that makes sense, but I'd appreciate some discussion.
Yep, we should add that to the FAQ at the end. I can give some thoughts on that at the end, but it's not explicitly addressed in this deck. But I'll leave that.
Mrinal, thanks.
Yep.
Thanks.
Economic flow 2 is seigniorage or interest. So the co-op will grant a 7% annualized seigniorage payment to validators out of additional issuance. This is consistent, actually lower than ongoing yield at other projects. So the treatment will be, it's going to be in an unbonded wallet, external to the bonding wallet that's staking. The payment will be made roughly monthly. And what I mean by roughly monthly is the first payment will be made in a month, and then the next payment will see transactions that are occurring versus last month. And when you hit that bar, it will be paid out again at whatever the rate is. And that would continue. You'd be measuring a rolling monthly average. And the incentive here is if you want payments to speed up and cash flow to speed up, you would try and incent more transactions on the network. And if you don't, cash flow would slow down. That does not change the rate. It's still going to be a 7% annualized rate, irrespective of which direction those payments go in. And as you can imagine, this leads to simple interest treatment. I think I saw a question come in. Let me just make sure. Okay, Phil, those are ref convertibles. We can address that offline. Any questions about the seigniorage and interest? Okay, then. I'll move to the next slide.
Hold on, sorry. I've got a question.
Go for it.
Regarding the monetary policy that was brought forward by the co-op, which, if I remember correctly, was 10% over the next 10 years. How is that handled with 7% seigniorage on the staked amount?
Well, first it says 10 to 100% over the next 10 years. But two, this is not 7% of total supply. This is only 7% of staked supply.
Yeah, I'm aware of that. So, but I mean,
but it's also 7% of staked supply. So if you think about 7% of staked supply, total supply is 860 million. There's an 80 million ROC in validator sale. If we sell all of it, assume that's matched by membership. So you only have 20% of supply actually out. So this would be a 1.4% rate.
Sure. I'm totally aware of that. So, but given that there at some point in distant future there could be the overall issued coins could be more than those that was brought forward by the co-op in the monetary policy. So what kind of mechanism is there to ensure that is guaranteed that is always lower than that given monetary policy?
So I mean, good point. As you pointed out, in the short term, it's less of a concern, just given what this number is relative to the limit there. But there's a slide after the transaction fees and storage section, which sort of talks about how we want to optimize that. Maybe we can reboot the discussion on this when we get there, because it is a very important point you're raising. So one answer is we've sort of thought through that a bit on how to offset that with transaction fees and storage. And two, second part of the answer is, that's really the reason for governance. Monetary policy might need to change depending on market conditions, and of course, that will be subject to a member vote. But at least in the short term, we'll be definitely compliant, given it's only on state supply.
Phil, it's a great point. It's a great point, Renal, about governance, which stresses the importance of the member vote and just understanding exactly what the issues are. And so there is a process that needs to occur whereby members become educated on governance, monetary policy, et cetera. So all of those things are up for discussion. And well, not specifically all of these things, but what I'm saying is that we're trying to come up with a process by which we can have these important issues addressed, and that the membership is fully aware of the impact of these decisions moving forward.
Okay.
Yeah.
So monetary policy is a huge issue, and probably at some point in time we need economists and people like that supporting us.
Yep, I actually hope that soon, right? It's when we're a victim of our own success that we need that. So yes, I agree 100%. And if I may just venture an opinion, I think what we really need to do, and this is one step toward that direction, is we can have much better conversations when we have good documentation. And I think like what we're trying to do with the validator sale and a lot of other things going forward is be a little less, call it, fluid and a little more tighter on documentation. That so conversations about things like monetary policy, rates, pricing, etc., can be specific. It still creates an open debate, but when we have a set of parameters to look at, it really helps. Cool. Any more questions on this, or should I move to the next slide?
To comment on governance and the fact that incentivizing validators so that we have a diverse set of validators to secure the network is important, a key to the viability of the co-op. And so therefore, we can pretty much say that when these numbers are no longer relevant, that the co-op is modified to fix it.
Yep, couldn't agree more. Anything else on this slide? All right. Well, PowerPoint's being weird. So the next slide shows a return example. And I actually want to walk you through the Excel, but let me just hit a couple of key points. What we wanted to ensure is that for a high stakes / professional tranche, it's high stakes on the form, it's just professional in the legal document that we have right now. So that's taxonomy I'm using. We wanted a true cash flow IRR of roughly 30%. And this is prior to any transaction or storage fees. And that's important because we know what the discount is and we know what the seigniorage is. Those are two things we can control. What we cannot control are the number of transactions or storage fees. So we want to be able to tell validators that as long as pricing is maintained of the underlying token, you are guaranteed a 30% IRR based on these terms. And of course, you can change the value of the token and it would be far superior to that. Let me run through the Excel really quick. Thank you. Sorry, my computer's
Probably also important to note that if the price goes down, it has the same effect.
Oh yes, yep, absolutely. Yeah. If the price
it
goes
depends
down,
on what you care about. This is on the underlying token is of 30%, not any notional fiat value.
100% right. Correct. You get a 30% IRR on the token. That is 100% correct. Yeah. All right. So this is an Excel model. This will also be distributed and posted to GitHub or wherever the document repository ends up being. Again, waiting for legal review, but I will run you through how it works right now. So up top here is similar to what you saw in the slides. These are the tranches, the start and end points. This is the discount. This is a seigniorage rate. And then an effective monthly simple interest rate that's calculated off of that. All the inputs are the blue cells. So a committed dollar amount. So this is a whale saying, well, he's going to put in $2 million. Price of rock is about 40 cents. Again, this is an input. You get a 24% discount. And so this really calculates off of this table. So there's an if statement that derives this based on what happens here. 30 cents is your price. And so this is how much rock you're given. Let me talk, before I address this cell, which is C17, let me just talk through the table. So assume you start staking from today. The amount of inflow into the system is $2 million, but nothing else happens. And this is how much rock you have in the wallet. In a month, you have the same starting amount, but then you add this much through seigniorage. And at the end of the period, you don't have any increase because that goes to your external wallet. And the outflow is this times the price of rock. And we're doing this to calculate actual IRRs. So this just repeats month after month. And so here is just a simple, straightforward example where, we have 18 months, you make a 29.7% internal rate of return. You make $899 if that's how you want to denominate it. And then, you have a money on money return of 1.45x. This cell is if you assume that rock price changes in one direction or the other. So assume you think it's going to reduce by 2% every month, all the way down to 28 cents. Even in this case, over 18 months, you still have a positive return. That's rock going all the way down to 28 cents. But assume you're fairly optimistic about it and you say, oh, 5 is actually pretty low. We've hit right. So say about 12% every month. Over 18 months, and we hit our prior all-time high of about $3. You actually 10.5x your money by going in the sale and validating, and this is your internal rate of return. I think I saw something in chat. Let me just check. All right, that's just Kevin's off. So that's how this Excel works. There'll be 2 more sheets added to this. One will be what does this look like for, and I've already made them, just error checking them. One will be what happens to people who already own rock and don't participate in the sale. What does it look like for them, the return, etc. And the other thing will be how transaction fees are actually split, because the equation can get a little complex. But if it's laid out in Excel, it should be fairly easy to process. Any questions on this?
Yeah, Renal?
Yep.
Can you return back to the slide that assumed that the stakeholders, that the price goes back to the prior RChain all-time high?
Oh, here? Yep.
Yeah, great. So what would be, I think, interesting in terms of understanding the motivations of people is to have another column that shows what the ROI would be for a person simply holding rock as opposed to participating in this. So what kind of appreciation would a person that had that amount of rock, not staked, but as, excuse me, it's like, yes, excuse me, it's 4 in the morning here. I'm kind of losing my my brain function. But do you see what I'm getting at?
Yeah, Jonathan, I think that's an extraordinarily good question, and also it addresses what I see as a problem with this slide, which is that there's a suggestion that rock might go to a particular level, and comparing it to just simply holding is the right thing to do. I think Jonathan's right on.
Well, I have no criticism in terms of this being a discussion or speculation about appreciation or suggesting that it will appreciate. I think this is a scenario, so I'm fine with that aspect of it in terms of legal compliance and our being where we are right now in terms of regulations. But just in terms of scenario building, I think that would be an interesting comparison.
Yeah, nice thing about Excel, Jonathan, is once we put it out there, you can play with it all you want.
Sure.
Just on the legal compliance as well, this model will go out with like the starting value will always be 0 here. So we're saying like our position is, we're not suggesting it's going to go up or go down. All right.
Yeah, sure. But if you add the column for comparing to simple holding, somebody that thinks they're just going to hold anyway can see it very quickly, and then there's no suggestion that.
Yep. No, I agree. I'm gonna run that by legal, make sure we're allowed to do that, and if we are, I'll add it in. Otherwise, I can just like, if anyone wants to know what that is, it's actually a fairly straightforward formula. So I'd be glad to talk anyone through it. All right. Any other questions on this one?
Oh, I wanted to make the point that the nice thing about this, regardless of price appreciation or depreciation, is that unlike any other crypto asset, this is almost acting like a bond as opposed to a speculative investment. And this is the way I approach talking about the advantages of a validator to various organizations that are doing crypto asset management for their clients, that unlike other crypto investments, doing this is providing a leveling, not guaranteed, but a possibly guaranteed stream of revenue to offset the volatility of the rest of the portfolio.
That's a great way to put it. That's the way I've described it to people too. It's a bonded return in exchange for you participating in the utility of the product. So yeah, I think that's a very appropriate way to think about it. Any other questions on this? All right, cool. As Greg would say, silence is golden. I'll plunge ahead. The other two return examples are just for medium stakes and lower stakes validators in the other branches. So the return comes down a bit because they don't access the, so it goes down from 30 down to 26 here for medium stakes and 23 for low stakes. But just wanted to make sure I had examples in there. All right, so let's talk about how transaction fees are going to be split. Let me define some key terms here before I jump into this formula. So for all the validators, there's two classes. So assume there's n validators. One of them is B, which is the person who is proposing the block. So B proposes the block, and he also proposes a variable called fee. And fee is what he's going to charge to put the block or to process the transaction. E are all the other validators in the shard. So n minus 1. So there will be one B and n minus 1 E's. Every other validator in the shard. The way fees are going to be split is there's a value called K, which is a shard specific, call it fee structure parameter. Now, you can look at these two formulas, but instead of going into detail in the formulas, let's talk about what's actually happening here. As K goes to infinity, the block producer B gets all the fees, And as k goes to 0, it's split completely evenly. So if k was 0, you know, and there's 10 validators, all the validators get, you know, an even split. However, you know, if k was infinite or close to infinite, b gets all or most of it. And never all, really, because, you know, no such thing as infinite. But that's a general idea. And again, this does not assign you the fee. It just assigns you a weight, which will be wx for each validator x. But I'm going to stop there because there's another phase to it after that. But did this come across? Or any questions?
And Mernal, just another minor point is that K is set up at genesis of that shard. So the validators who are going to kind of come together to say we want to create this new namespace, they define what K is going to be. I'm not sure if K can change over time or not, but that's an important point too, so that you would know K going up front.
Right. Yeah. I guess the way K could change is a validator proposes it and everyone else accepts it. Right. They send a contract to redo the SLA and everyone accepts it. Similar to like the bonding process, right?
Yeah, it's part of consensus.
Yeah. Right. So as long as you can get everyone in the shard to agree with it, you could modify K. All right. Any other questions on this? Or, otherwise, I could move to stage 2.
Yeah, I've got a question. Will the fees be pooled, and over a certain amount of time they will be split up regarding to the stake, or will they distribute it for every block separately?
Great question. We don't have an answer. We're going to figure out that'll be decided during testnet as well, just to figure out what's most optimal. The idea would be to distribute it as often as is feasible without having too much of a computational load, as you'd imagine. Any other questions? All right, so I'll move to part 2. So this gives you a weight, which is Wx. So calculating BNE, oh, darn. All right, calculating BNE will provide an initial weight. But we've not really done anything related to what stake you have up till this point. So we now need to stake weight it further. So for each validator X with a stake equal to S of X and a weight of W of X, which is calculated here, fee for that validator X is equal to the total fee times their weight times their stake, divided by the sum of the weights and stakes, weights times stakes of everyone in the validation system. So therefore, this is to decide how you're splitting between the proposer and the non-proposing validators, and this is to then appropriately weight it by stake. And then, of course, within shards, we expect that there will be stake minimums and maximums to avoid someone dumping everything on one node just to collect all the fees. Any questions on this one?
Yeah, might be obvious, but I don't see why. Why are there 2 parameters for weighting the stake? So S and W.
W is calculated here. So W just tells you, are you the proposer or are you one of the non-proposers, right? The proposer has a certain W and all the other E's have another W.
I see. Yeah.
Right? Okay. And then you have to stake weight it.
Yeah.
Said differently, it's there to provide an incentive for to not be lazy, that you actually have to propose blocks.
Yeah. I didn't notice that the W is just whether you're the proposer or not. All right, perfect. Thanks.
Cool. Any other questions?
Last one, Mernal, well, maybe not. Are stake amounts equal for all validators?
No, not necessarily. So it really depends on the SLA within the shard. So not necessarily. Very, very often it won't be actually. And that's sort of here. In fact, if it was equal, you would never have to do this calculation. And I think like that might be sort of a routine to test, right?
Yeah. So, but having a minimum and maximum gives you a range. But if you have a tight min max, then it's less relevant versus a high min max. Yeah. But you will have a max, which is important to note. Because that has
absolutely.
we do want people to need to be able to spread out in order to put their stake in different places, not just all your stake in one spot.
Yeah, and we make that very clear in the legal documentation in the purchase for the purchase, where we say, in addition to committing to the lockup and the hardware plan, you're also committing that you'll set up as many nodes as is required to spread the stake out, because in anticipation that, especially for the whales who went by a few million rock, you tell them that it's pretty unlikely you can put this on one node, and so they'll have to set up several. Cool. Any other questions? All right, I'll move to the next one. Which Phil, hopefully at least at a high level answers one of your concerns. So if you think about it, we're seeding the economics of validators through this discount in seigniorage. But as the network grows, we expect transactions to grow rapidly, which is the red line. And again, this is all illustrative. And as volume increases, the cost per transaction in storage should come down, because you're spreading the same level of capex across a much broader transaction base. And just to give you headline numbers on that, we're thinking about 1/3 the cost of Ethereum at launch per transaction, and hoping to get to about 1/10 of Ethereum by the end of the high seigniorage period, which is the first 18 months. And then we expect over time that transaction and storage fees will be the main source of ongoing economics. So, out the gate, we think we'll be 90% plus. The money is really going to come from seigniorage, but over time, we want that to flip. Again, this is completely illustrative. It's kind of chicken and the egg, because it's hard to calculate, because as you can see, as transaction volume goes up, pricing goes down. However, this is the mix that governance will target policy towards. And, some of the factors that'll be considered are transaction volume, transaction cost, and the percent of token supply currently staked, which goes to your point, Phil, that we want to be compliant always with whatever our current monetary policy is. But going forward, we have to find a way to be able to modify that with, of course, member processes and consent to create this, because to your point, we don't want a forever inflating economy. We want to get to this state as soon as possible. So more people build, the quicker we get here. I'm going to pause there. Any questions on this slide?
Just a quick note on governance, and it is actually a bit of a two-step process, or a dance, you might say. So the cooperative made up of its members will decide through voting what a policy on monetary policy would be. That would be instantiated in code, and then that code would either be run or it would not. So there could be other networks that are like RChain that have different monetary policies, but that would essentially be what we would call a fork. And in this case, what governance means for this project is that we have a governance process off-chain. That governance process off-chain informs on-chain, and then that is what is the legitimate source of, or the reason it can be called RChain is because it is made up of the membership. Whereas Ethereum is a foundation that puts forth a suggestion that people may run or not. There's no participation other than that. slight nuance to that, but should be interesting times when the co-op comes together to try to decide monetary policy.
Yeah, I couldn't agree more, Kenny. And I think, especially for discussions like that, I think as we were a smaller group, a lot of these were done informally and verbally. I think going forward, it's a personal view, and I think a view shared by a lot of members, we need to be a lot tighter on documentation. And it goes to your point, Kenny, where, you know, the expectation of announcements and response shouldn't be ours. Like, we're moving towards being a much more professional organization, and people, you know, should give people in charge of things time to put stuff together. For example, this deck was in response to like a lot of member requests where they wanted, you know, we saw the requests that we were getting from validators incoming and members, and if we didn't know what are the key questions to answer, we wouldn't be able to build it. But, you know, to get something that's comprehensive, it took us, you know, a week or two. And so I just think, you know, this is a test, and hopefully, like, going forward, you know, people realize that communication sometimes have delays because of that. Anyway, rant over. I just wanted to address Jonathan's point really quick. Yeah, the fonts here are consistent with Gervin's brand guidelines. I'm liking them too. I think they work pretty well. Any other questions on this slide?
Hey guys, Ralph and Jake here from Drone Energy. Sorry we're late. How many slides deep are we right now?
I believe this is slide 9. However, this conversation has been recorded and will be posted up to the RChain YouTube channel. I don't know when exactly, but so you guys can go over it. But any questions that you had in the interim?
Not yet.
All right. So unfortunately, that was actually the last slide. So we have links to some resources here. This will keep expanding. There will be a dedicated validator website, which will have a complete step-by-step and technical guide that's currently being built by Zensoft. There's some general questions here. So I'll just go through these really quick because they weren't really covered in any of the germane to any of the other topics. But one is bonding an open process. Yes, it is. It's a submitted transaction. And, you know, as long as all the other validators approve the transaction, bonding will occur. Is there a set commitment period before which a stake can be unbounded? So this is actually going to change. It's going to be initially 6 months as well. So initially we thought 18 months, but it's going to be 6 months and then 6 month increments going forward. So that 18 is gone. Again, upfront discount, again, this is 6 months. We're changing this one. This will extend as long as the validator sale lasts. All shards will receive the same level of economic incentive, and most likely backbone validators, that's root shard, very high throughput validators, will likely only be in the high stakes pool given the proportional cost of hardware to stake there. And then there are outstanding hardware questions, but this will be a live document that we'll keep editing. And please note that this deck in general is going to be a live document. There's things that move, especially as we get more information from Pyrofex, and we'll try to keep it updated and on the repos once we have legal approval and once we've
Pardon to interrupt, but can we receive the deck before it's posted to YouTube, like immediately?
We're just waiting for legal review. We're hoping that that's done end of day today or early tomorrow.
And then where would we get it?
Yeah, we just want to make sure nothing in this like violates securities laws.
Right, that's fine. And then once it's available, where will it be available?
Well, we'll make an announcement on the Discord, but most likely, I don't know, Kenny, should we put it on, like, should we just link it to your blog post and also put it up in the GitHub? Because that's what we're using right now.
The blog post needs to get updated with some more of these points here, and then all of the documents, as well as the initial documents that John had presented last week, are on GitHub.
Great.
On that link there.
Is that legal docs folder?
Yep.
Okay, cool.
Ronald, I think your deck has a mix of 18 and 6 months because it was changed recently. So
Yeah,
if it
yeah,
goes
on this
people will
part,
get
right?
confused.
Yeah, yeah, on this part. Yep.
Yeah, this is an awesome job, guys. I think it was really clear, well presented. Did a great job. I'm wondering if before the 3 minutes here, if you might share a thought or two on the pools issue that came up.
Yes. So on the pools, my point of view is, so typically this is how other projects have done it, and we might want to change going forward. On pools, other projects haven't handled that as part of the platform itself. It's sort of been organized off-chain, meaning Ethereum staking pools are or Dash staking pools, you sort of have to trust the organization that's saying, hey, we're going to pool these assets and thereby distribute the returns. So we don't have an answer right now from a technical perspective about pooling. Everything accretes to the external wallet linked to the bonded wallet. However, if someone wants to provide a pooling service, that's definitely a business line, but that would be external to the actual underlying platform. I know that was slightly rambly. Did that answer?
Reynold, that sounds exactly like the kind of thinking that we need, and there probably needs to be standards for how much a pooling mechanism would charge, how to decide whether they're reliable. Staking can be risky. So yeah, Phil, maybe you have a suggestion.
No, I kind of agree with Brinal on that. That is, these are some services that are provided externally within the ecosystem. There are several solutions that can be, the fund management can be centralized, or it can be totally centralized. Fund management can be centralized, but the payment mechanism can be decentralized within a smart contract. Can be a total decentralized solution with a whereas even the protocol messages are basically signed by multiple parties. So there are several solutions. I think there will be some services provided by some members within the ecosystem, and yeah, it's not something that should be directly in the protocol.
Yeah, we're hoping to make it easy for members to create these pools. I realize these would be separate, but could be supported by the co-op in some manner. Members making their own.
It sounds like it's almost a DApp-like thing where there's a third party that puts together a proposal and anybody can invest with their pool based on what they say about it.
Thank you very much. I gotta go. Bye-bye.
Yeah, Alan, that sounds right. It could be a DApp, and to Phil's point earlier, if they're able to construct it using smart contracts in a way that's kind of trustworthy to participants, that may alleviate some concerns.
Hey, Bernal.
It won't be part of the protocol. Sorry, go ahead, Jonathan.
So as you're aware as well, there's been some fear, uncertainty, doubt, and hand-wringing in some of the Telegram groups recently.
Really? I'm kidding. I'm kidding. Go ahead.
Okay. So at any rate, this is a nice informational piece that is relevant to the kinds of discussions. But I was wondering if there were any plans to utilize these materials to specifically address some of the specific concerns that are being expressed in our community forums.
Yes. So the answer is yes. So one, I basically invited everyone to just get on this call. I was like, look, every question will be answered. And if there are more concerns and people want to do this call again, I will do it again, and we can do it as many times as people need to like get the information across. That being said, once we have full legal approval, this document will be posted to the GitHub. And so if anyone asks questions that are answered here, I'm going to let the moderators know that they should just direct them to this. And so, we have great moderators on Telegram, and so they'll know where to send them if they say, hey, what's the price or something, and they know where in the GitHub to send.
Great. And my standard RChain Asia observation here from Singapore is that we would want to do such a thing at a time that was actually convenient for people living in East Asia. It's 4 a.m. here, and I doubt that many of the people that have been particularly vocal in the Telegram groups would even consider logging into this particular Zoom session, even if they had the URL in a timely fashion. So I strongly urge that we set up some sort of time that is posted in sufficient advance notice, that we could communicate directly with some of the people that have been most actively interested, I'll use that word, in what's going on with the Validator cell.
Yep, no, I think that's right. And I think especially, look, stage one was us figuring this stuff out. Like I said, it's a bit chicken and egg. We had to like test the market, talk to people, find out. Now that we have, pretty good idea of what we need to do to get this done, we will firm up the community. We were firming up the sale process and pricing, but we'll firm up the communications process going forward. I think, maybe it's a bi-weekly call or something, and like we maintain a cadence, because validation is going to become an extremely important part of this. And while right now everyone cares about price, etc., when all this like FUD cools down, I think what people are actually going to care about is, how do I set up my node? What kind of hardware should I be buying? And I think like there needs to be a weekly cadence that these people who have put capital up to run this have access to information every week. But we'll get to that. It's a great suggestion, and we need to start doing that. But once we have all the infrastructure in place, it's just going to be much smoother.
Right, and I certainly didn't intend for my comment to sound like a criticism. It was more an attaboy, and please, more. This is great. And
no, wasn't taken that way at all.
Great.
And also, don't worry about criticism. I get yelled at all the time. I'm used to it now.
Hey guys, here's a question. It's Ralph from Drone Energy again. So we just got off a conference call with a hedge fund based in Los Angeles that's seriously looking at partnering with infrastructure companies that are staking numerous stake chains. And their big comment is, hey, we're watching a few chains, and our chain is interesting, but they've done less of a job in Cosmos, in particular in marketing. And we're really not sure what their economic model is. It's less transparent. And so what would you guys say to that?
So I'll go first, and like if anyone else has another response. So first, let me address the marketing point, because I think that's very important. The marketing has been very, very low by design. And the reason for that is we are designated as a 5.3c utility company in the state of Washington. And therefore, anything we do that looks like we're trying to like increase, like if we don't have a utility and we make something look like we're just trying to increase the price of it, we could lose utility status. So we're ultra compliant when it comes to that. And therefore, you can't really advertise or market heavily unless you have a running piece of infrastructure. The good news is all of that changes on September 5th, where we'll have a live testnet. We've actually allocated a $7 million budget for marketing. There's a new website that just hasn't been released. We'll start beginning listings on large exchanges. And all of that's going to start happening after the testnet's up, because we can only do those activities once we have a running piece of infrastructure. At a high level on the economics, I'd say, look, there's two sources. There's the 18 to 24% discount, depending on the size of the validator. and plus there's a 7% seigniorage for staked supply. Combined, if you're a large validator, that comes out to a 30% IRR just on the token, assuming no change in price. Both the Excel, that's the backup to this, and this deck will be shared with whoever needs it on the it'll be on the GitHub, and I'm glad to send it out to whoever needs it once we've just completed legal review and make sure we're not against any securities laws. I'm going to pause there. Did anyone else did I leave anything out that other people think should be emphasized?
I would just like to add on the marketing front, a lot of the work we have been doing, this is Shahan from Reflective, a lot of the work that we've been doing has been leading up to this moment. So one thing you might not be aware of is there's over 20 different portfolio companies that are going to be live on the mainnet as well, that are coming out, and there's a bunch of marketing behind that as well. The mainnet release, there's some big marketing efforts for RChain and what will be released there. To Ronald's point, a lot of that was done by design, and this is the stage where you're going to see an extreme amount of ramped up efforts in terms of rolling out all of the marketing material. So there's a bunch of stuff that's rolling out in terms of educational material. There's different things we're doing of different partner spotlights and different portfolio companies that are building on top of RChain. And then this validator sale as well, which is attracting a lot of attention. But we hear you, and it was by design, but you will see a lot of developments over the next few months.
Great, thanks guys. Those
I'd love to know. I'd love to know how many people on the call are actually contemplating being validators.
I am.
All right.
By show of hands, right? So in chat, what do you want? Drone Energy certainly is.
Okay, very good. Okay, awesome. So yeah, I mean the main thing I'm most concerned about is that we actually reach out to people who are going to be validators, and because a lot of times we've done sort of kind of market testing, but until we get to the folks that are really seriously considering being validators, no amount of market testing is effective. And that's part of what we've been experiencing. It's just and I think it's natural to kind of make a few proposals and then get some more feedback and make a few proposals until you finally land on a value proposition that seems to be superior. And I think Mernal has done a really good job of articulating that. I'm curious as to what other folks from the validator community are finding as sort of their burning question.
When is the validator sale?
We've already closed at least one validator deal, so it's actually underway now. So if you have expressed your interest by emailing to staking, then you're in the pipeline, and we will be reaching out to you, or you've already been reached out to. How many people have already put in proposals into staking?
Well, I can give you the exact answer if you'd like, Greg.
No, I meant here.
We have not yet.
Okay.
We just found out today that we can stake our current rock.
Ah, okay.
Through the validator. Yeah.
Okay. So that's an important point that we need to get better on. So we had hoped with both private sales, that people would understand that the rock that they bought would perform would be eligible for staking. So I'm glad we're making this clarification now. That's a really important point.
If we purchased rocks on the open market, is that ineligible for staking?
A rock is a fungible commodity. A rock is a rock is a rock.
Yeah, that's what we thought. Okay. Another market question. Looking at CoinMarketCap, we see circulating supplies around 380 million, total supply 870, max supply a billion. Are these validator sales coming out of the total supply and therefore increasing the circulating supply, or can you guys give some comment on that?
Absolutely, yeah. So the additional 80 million that was approved by the board is coming out of the co-op's treasury. So that's coming from the total supply and increases circulation.
Okay, so it's kind of a dilution, and you guys are fighting that with the lockup period?
I don't really see that as a dilution. I see that as a redistribution. It's going out of the hands of the co-op and into the hands of validators.
Yeah, I'd agree with Greg in a sense that I think the terminology that CoinMarketCap uses isn't really that useful. I think about 860 million sort of as the supply. It's just some of that's held by co-op for, you know, business development, validation, research, and other needs. And so really it's not changing the supply. I mean, that could be circulated technically by a member vote at any time. And so it's really just a redistribution to help secure the network.
I just want to make sure, does that answer make sense? Do you understand why we hold this position?
Yes, but does it also make sense that, you know, the market cap reflected on CoinMarketCap is essentially 150 million, which you get there by the circulating supply multiplied by the price. Therefore, if you say we're going to issue more, circulating supply goes up, and you are impacting the market. So it's good there's a lockup, so you sort of mitigate immediate dumping if there were to be any. But I think that's basically what the Asian crowd and Telegram's concerned about, and that's what the argument is, right?
No, the Asian crowd was concerned about a strategic partnership arrangement that we've been cultivating with Seaway, in which we did a rock purchase to Seaway Investment Group, not at the validated term sale, but on different terms that were in support of the strategic partnership. So that's what the Asian community has been upset about. The validated terms, everyone seems to be quite happy with. The major feedback we got from the Asian markets was that the lockup period was too long. But apart from that, the central concern was that that Seaway was being treated differentially, and that the rock that they purchased was without lockup. But there was a miscommunication around that. The co-op has been advertising for several months that we were working with Seaway towards a strategic partnership, but there's a language barrier, and it wasn't made clear enough for the Asian communities what was going on there.
Thanks for clearing that up.
Sure.
Were there any other questions? I'll hand it over to Kenny and Greg.